Hello, welcome. Today I want to discuss inflation, real value, and nominal value. Many people have questions about the value of their coin collections and how values differ over time, and often ask for investment strategies. Now, this video is not an attempt to make uh, suggestions on how you should invest your money in any way, but this video does illustrate the very textbook basic values in terms that are used in any investment strategy. Now we can see here we have a question: best coin investment strategies. I see threads like this almost every day. Here's another um, forum follower who's noticed that barber coinage seems to be commanding a premium over other types. And what would you sell? These questions come up every day. So hopefully we'll dive into some of these basic terms, and it will give you a framework in which you can work and play. So let's start with inflation. What is inflation? Okay, it's the rise in the general price level of consumer goods and services over a period of time. Now, this is often used to illustrate that a dollar tomorrow is worth less than a dollar today. Okay, this helps explain why prices rise. Now, how do we measure the general price level of consumer goods and services? In the United States, the Bureau of Labor Statistics publishes the Consumer Price Index, or the CPI. You will see this in a lot of investment literature and economic material. Okay, this is a measurement that the government, they poll households, um, asking them a variety of questions and how much their goods cost. Okay, and this measures the basic price level of household purchases. And we can use these measurements over time to illustrate the rise in the price of goods. Okay, this gives us an inflation rate. Now, what causes inflation? That's a great question. Basically, the bank prints money. The Federal Reserve prints money, and they hammer out coins. Now, an increase in the supply of money decreases the value of existing currency. You can skip to the end of the video and I will discuss the gold standard a little bit, but I will not do so here. Now, I want to dive into two examples of how our numismatic items the price and values might vary over time. Okay. Before we do that, let me explain right quick. Real value and nominal value. Okay. Now we understand inflation, and we understand that the value of a dollar decreases over time. So how do we look back and figure out if we have made a good investment? We have to figure out the real value of that investment. Okay? The real value of an investment is the value of an investment after removing the effects of inflation. Now, a nominal value is the price of investment at the time of purchase. So let's say in 1966, your grandfather stuck a few $100 red notes in the vault. Now, at that time, obviously, it cost him $100 to do that. If you were to pull those 1966 red notes out of the vault and sell them today, would you have actually made money? Here we have a CPI inflation calculator from the Bureau of Labor Statistics. This is a government website. Here we have the $100 bill in 1966. that has the same buying power as $707 in today's money. Now, if we were to sell that 1966 $100 red note in gem condition, it would have to sell for at least $707 for us to see a return on our investment. Is this true today? Well, let's look at eBay. I've already done a search. Here we have an auction that actually ended. It sold for $760. This is a graded red note, gem uncirculated 67. Now, did the seller actually realize $760? Of course not, because he had to pay for eBay fees and most likely PayPal fees. You can expect 10% to come off of that price. The seller realized, in essence, less than $700 on the sale of this note. Let's look again at our calculator. His sale did not trump inflation, so we can see here that even in a gem uncirculated, this was not a very sound investment. We can scroll down here and see that some of lesser quality went for substantially less value. Here's 4. So you can see what I'm getting at here. Now I want to demonstrate also how this might work in with coins, especially rare coins, and even between grades of a particular series. Let's use the 1909 SVDB as an example, as an investment in a rare coin. Now here's a historical value trend for the 1909 SVDB, and let's assume that in 1980 you bought a coin for $210. Now let's return to our inflation calculator. $210 in 1980 has the buying power of $583 in today's money. Now, if you sell your coin, you must sell it for at least $583 to see any return on your investment. Is this true today? Can you do that? Well, let's look back at eBay once again, and let's see what kind of prices we're getting here. Here's a PCGS VG10 sold for $825. Seems to be a sound investment. Maybe you would have actually made $100 or $2. Now let's do something a little more interesting. Let's say that you bought this coin in 2003 and you wanted to sell it today. Have you made any money? Yes, it does seem that you would make money if you could sell it in a slab for that price. Very little money though. Now let us take the same 1909 SVDB, and let's say in 2003 you actually invested in an MS65 in red brown. You paid $42.50 for it. Today you want to sell it. Will you make a return on your investment? Adjusted for inflation, we see that if you want to sell your MS65, you'll have to sell it for at least $5,291. According to the price guide here, no one's going to be willing to pay that. Okay, so we can see here that you may have been able to make money with this coin in a lower grade. The higher grades, perhaps the demand has dropped, or even perhaps the demand has shifted from MS65 towards the lower grades. Now, when considering to make long-term investments in precious metals, you again have to consider the effects of inflation. Just because, let's say, you buy silver in 1983 at $30 an ounce and sell that same silver in 2011 for $35 an ounce, doesn't mean that you've gained any real value. In fact, your investment may have lost value. Furthermore, looking at this chart of real silver inflation adjusted prices, we can see if you invested in 1983, you would have had to have waited over 30 years to realize any maturity in that investment. Now, obviously, there's great risk during these 30 years, and hopefully you live long enough to see that, or you don't need it. You don't have an emergency between. Now, where a lot of people try to play these markets are examples right in here where we have short-term increases. Okay, this is typically where people want to maximize their investments, is identify when these things happen. Okay, now let's look at gold. Gold's a little different. Here we have the real prices again, but it's very much the same story. You see, if you invested in gold in 80 or 81, when gold was between 1600 and 1800 in real dollars, you wouldn't have seen a return on that investment until the big spike just a year ago or so. Again, here's the nominal values down here. This is what gold was going for at any given time of measurement. Obviously, these measurements are not dailies, so you may not see some of the drastic spikes. Same is true with silver. You see the nominal value here is only up to 35. This data set must not have included the spikes that were up near 50. Okay, I do have those. It's right here. But you see the same trend. This is a nominal chart. You see the same trend here, this trough and a big rise. Coming back over here, here we have that nominal shape. Here's the nominal figure, slightly different scale. Okay. It's important to adjust all of these prices for inflation. Silver inflation adjusted price. This is the real price. Okay, I want to return briefly to why does inflation exist. There are many theories and reasons for this, but as can be seen by this chart, this is the annual rate of inflation. You can see a stark difference here starting in 1971. This is when the U.S. was taken off of the gold standard, and we see a drastic annual increase in the inflation rate. Now that's because, for the most part, historically, money was tied to a finite supply of gold. There's only so much gold, there's only so much we can pull out of the ground. But when you shift economic markets to be based on paper money, which we can print whenever the federal government deems it's necessary, we can see sharp increases in inflation. And in fact, where is this going to stop? Where is the ceiling? That's the big question, and I'll leave that for you to ponder. And I would suggest, if you want to do some more research, you also look at the U.S. Interest rates, which have been nil for very, very long. So thanks for watching the video. I hope that explains a lot of things, and that you can utilize this information and possibly alert others to the effects of inflation upon your investments.